Welcome to the Deep Dive. Today, we're really trying to cut through all the noise, trying to figure out what the market is actually signaling right now.
Exactly. We're looking at insights from Ryan Detrick. He's the chief market strategist over at Carson Group. Shared some interesting thoughts in a recent interview. It gives us, well, a pretty good lens to view things through.
Right. And our mission, really, is to get into the data points, the history he's talking about, just to get a clearer picture, beyond the day-to-day headlines that can just pull you in every direction.
It's about understanding what the market itself is saying. It's internal language, not just, reacting constantly.
Absolutely. And speaking of signals that might surprise you,
Yeah.
we're actually going to kick off with one that sort of turns a classic market saying on its head. Okay, so let's unpack this first point. The source mentioned May's performance. Pretty strong, it sounds like.
Oh, yeah, really strong. The interview notes, the S&P 500 looks like it finished May up 5%, maybe even a touch more.
Which kind of feels wrong, doesn't it?
Yeah.
Because you always hear that phrase, sell in May and go away.
Right. Everyone knows that one.
But the source seems to point to something totally different when May is this strong, like a historical pattern.
Precisely. And the data brought up is, well, it's pretty compelling. There have been, I think, 10 times before. 10 times where the S&P 500 gained at least 5% just in the month of May.
Wait, 10 times?
Yeah.
What happened next?
Well, this is the kicker. In all 10 of those cases, every single one, the market was higher a year later.
All 10?
Yeah.
Seriously, that sounds significant, not just random luck.
It really does. And the average gain wasn't small either. A year out, the average jump was nearly 20% in those specific instances.
Wow. Okay, so that whole sell in May thing.
Yeah.
It's basically flipped on its head if the month starts out this powerful.
That's what the analysis suggests, yeah.
Is there a reason, like, why that correlation might exist? Or is it just one of those market quirks?
Well, according to the source, it suggests the market might be building some serious momentum, maybe overcoming that typical seasonal weakness we sometimes see. A May like this, especially if it follows maybe a weaker start to the year, it hints at some real underlying strength that tends to carry forward. Think of it as a strong historical clue pointing towards more upside.
Okay, so that strong May is definitely a key piece. But what was the lead up like? Was the market just terrible before May hit? What was the setup?
That's a fair question. Context matters. The market did have a correction earlier in the year, and the source notes this wasn't entirely unexpected. Actually, their own outlook had flagged a possible, 12 to 15% drop, peak to trough, likely sometime in the first half.
And just so we're clear, a correction, that's usually like a 10% drop from the high, right?
Generally, yes, 10% or more.
And peak to trough is just literally top to bottom of that dip.
Exactly right, measuring the full extent of the decline. And interestingly, there's historical precedent for that kind of move around this time of year. If you look back, say, 20 years, the first quarter, it's often been the weakest, especially after a really big up year, like a 20% plus gain.
Yeah.
Plus post-election years, historically, they tend to start weak too, often find a bottom around early April, then start to gain traction.
So the correction we saw wasn't just like random market jitters. It actually fit into a known historical playbook almost.
It seems like it did, yeah. The source kind of frames it as a shakeout, after 2 strong years back to back, maybe a necessary pause, clears out some froth, resets expectations a bit.
Okay, this is where, for me, it gets really interesting. The source emphasized how strong the rally was after those April lows.
Yes, that's a really significant observation. The rebound that started looks like around April 9th. It was highlighted as just one of the biggest 27-day rallies ever recorded, surged over 20% in, less than a month.
And that kind of speed, that power coming off a low,
Yeah.
that's not typical, right?
Not at all. Exceptionally rare. The source actually compared the speed and the sheer size of that bounce to the kind of strength you see coming off major historical market bottoms. They mentioned 1974, 1982.
Oh, those are big ones.
2009, and even 2020. Really significant lows.
So seeing that same kind of horsepower this time, what does the source suggest that implies?
Well, the implication drawn from that comparison is pretty powerful. In those past cases, those major bottoms, the market didn't just roll over and make new lows. It kept going higher.
It held?
It held and continued the upward trend. Now, obviously, every time is different, but seeing that kind of rapid, intense strength off the April lows, it's presented as a strong signal, a signal that a pretty important low might be in place.
Okay, so we've got the price action story. Strong May, the correction fitting a pattern, this massive bounce off the bottom. But what about sort of under the hood? What's happening beneath the surface? The source mentioned market breadth.
Right, breadth is always crucial. You want to see if a rally is healthy, if it's sustainable. And the source specifically pointed to advanced decline lines hitting all-time highs. Mentioned the NYSE advanced decline line doing this recently.
Okay, and what does that tell you? What's the signal there?
It tells you there's broad participation. It's not just, 5 or 10 mega cap stocks pulling everything up. A wide range of stocks across different sectors are actually moving higher. That's usually a hallmark of a healthy bull market. It's seen as a sign of fundamental strength beneath the main index numbers.
And even back during that pullback in April, the source highlighted another signal that seemed surprisingly calm. Something about the smart money.
Ah, you're probably thinking about the credit markets. Yes. The source highlighted that even around April 9th, when stocks were down quite a bit, the credit markets, bonds, spreads, they were holding up pretty well, surprisingly stable.
Why is that considered such an important signal, the credit markets?
Well, they're often seen as a leading indicator, maybe the leading indicator, because they deal directly with risk, with debt, with the financial plumbing of the whole system.
Right.
If credit markets start seizing up, if spreads blow out, that usually signals serious trouble ahead, real economic or financial stress.
So the fact they stayed relatively calm.
Exactly. The fact they were stable during the stock market's wobble in April, that's presented as a strong sign. It suggests that despite all the worry in stocks, the underlying financial system was okay, which points to the stock drop being more like a correction within a bull market rather than, the start of some systemic meltdown.
Okay, let's pull these threads together then. We've got this surprisingly strong May, and its history suggests good things ahead. We have a correction that actually fits some historical norms, maybe acted as a reset. Then this incredibly powerful rally off the lows, the kind you see at major turning points.
Yeah, very rare strength.
Plus, strong market breadth, showing lots of stocks are joining in.
Broad participation, yeah.
And finally, stable credit markets, suggesting the foundation was solid even during the dip. So putting all these pieces together from the source, what's the big takeaway message?
I think the overall message, based on the source material, is that, look, there are always risks, always headlines to worry about, right? But the market's internal signals, they're suggesting underlying strength, real momentum. The combination of these factors points towards, according to this analysis, the market wanting to go higher. They even suggested this might favor certain areas like U.S. large caps, maybe cyclicals like financials, industrials, assuming, of course, no recession, which they didn't seem to anticipate.
So the message feels like ignore the daily churn, maybe. Listen to these deeper signals coming from the market's own structure and history.
That really seems to be the core idea presented, yes. The data, the patterns, they paint a picture of resilience and, potential for more upside rather than signaling some kind of imminent danger.
Okay, so just to recap the key signals we've dug into from this source. That May strength, surprisingly bullish historically. The correction, fit the pattern, maybe needed.
A reset.
The rebound, unusually powerful, like off major bottoms, market breadth, looking healthy, broad involvement.
Confirmatory signal there.
And credit markets, stayed calm, signaling stability underneath.
Yep, those are the key pieces of evidence cited. And together they suggest a market that, likely wants to keep climbing.
So despite whatever you might be reading or hearing day to day, these internal signs, based on this strategist analysis, they're pointing pretty clearly.
They seem to be suggesting the market absorbed that earlier volatility and is now signaling, an intent to move higher.
It's about looking past the surface noise, understanding the bigger story the data tells, especially with that historical context. So let's leave you with this thought. Considering these patterns we talked about, like May's surprising strength leading to gains, or how corrections can fit into predictable cycles, how might you think differently next time the market corrects? Or when you see unexpected strength in a particular month? Does it change your perspective?
And maybe ask yourself, is it possible these internal signals, breadth, credit, the way the market moves, are they telling us something more fundamental about where things are headed? Maybe something more reliable than the day's headlines, especially when things feel uncertain. Gives you something to chew on.